Hi, good afternoon and welcome to MF Corner. I'm Sumera Abdi. On the show today, first we'll talk about what are the big behavioral biases that can decrease the performance of your portfolio with Prableen Bajpai of FinFix Research. And later on the show, it's been a bumper few months for arbitrage funds. Should you invest in them? Will the going remain good? We'll have Costa Belapurkar of Morningstar India joining in to talk about that. But first, let's talk about behavioral biases. Prableen Bajpai, who's the founder of FinFix Research, joins in. Hi, Prableen. Good afternoon. And you sent a very interesting survey, the BEFI Barometer survey, which incidentally, for those who may not know, is a survey of some of the top financial advisors of how they view behavioral patterns when they talk to their investors, or what is it that they notice, right? And you'll see some of the biases listed over there, and if you compare it to 2019 and 2020, almost every kind of bias has gone up, right? So Prableen, let's start with this recency bias, because this tops the list, right, of the BEFI survey that you've sent us. What is recency bias and how can it be avoided?
Good afternoon, Sumera. Pleasure to be on the show. Recency bias, yes, it's topping the chart with a 35% actually, what the survey finds. Recency bias, Sumera, is nothing but a tendency as a human that we give more weightage to a recent event as compared to an event which has happened earlier. And this, when it comes to investing, a lot of investors fall a victim to it because they give more importance to any recent event, or in fact the recent performance of any particular asset class or a scheme. And this leads to a myopic vision, and they tend to start drifting or shifting their portfolio towards an asset class which looks promising at that point in time. And of course this can be, it can jeopardize the long-term returns or the right asset allocation for an investor. One example I'll give here is of gilt funds. 2020 March till about 2020 March, this category wasn't big. It was about a 8,900 crore category, and the Franklin episode happened, and we saw a lot of inflows into this particular category. It in fact hit the highs of about 20,000 crores in October, November of 2020. And Sumera, of course, it was the flight to, moving away from credit risk to a sovereign-backed instrument, but without realizing that these instruments have their own kind of risk, which is duration risk. And the other factor which, a lot of investors probably felt attracted was that these particular funds had shown great returns. And the same phenomena is seen in FOFs, it's seen in sectoral and thematic funds as of now. They are seeing huge inflows. So how do you overcome this bias? I think just the way, we stretch our screens and we want to expand and see. So you, as an investor, one really needs to look at a larger picture, look at the rolling returns over a longer time period. If you're looking at past returns, also look at the best and the worst. If you're looking at worst, please look at the best returns as well. And of course, understanding that constant churning does not result in better returns, and it is the overall asset allocation.
Okay, so the next worst thing then is loss aversion, and to a great extent I can even understand that, and I guess it doesn't really need an explanation, but how much does it impact investments, and how does a person overcome their aversion to or fear of losing their capital?
This one is very interesting, Sumera, because it has such a human tendency. We all hate losing and we would do anything to avoid losses. And there's this interesting paper which was published in 1979, and it said that the pleasure that we get from gaining something is, if you're losing the equivalent of the same amount, the pain is much more when we lose something as compared to the gain in getting something. And when this particular bias is in extremes, people actually tend to cut down their losses. They want to move out wherever they are seeing any negative returns. And I think what we've seen, people stop SIPs, they want to move out of equities, is somewhere, manifestation of this particular bias. And the same feeling, I think, how do you avoid it? It's simply that you cannot look at investments individually. You need to look at a holistic picture. And AMFI data actually suggested that from July of 2020, a lot of people started moving out of equities for 8 consecutive months. And to some extent, it was probably for the need during the pandemic, but to quite an extent, it was seen as that, okay, they were happy that their losses were recovered and they wanted to book some profits. So this tendency in extreme leads to very conservative creation of portfolios, Sumera. So a very balanced portfolio needs to be created to overcome this particular bias.
What about familiarity bias? Because I mean, what exactly does it mean and how do you overcome it?
It's our comfort zone, Sumera, because we all love to be with friends we've known. We all love to go to places, we are regular customers too. So it's basically investing in things we are comfortable with. And I think the very fact that in Indians, the wealth, 95% is held in real estate and gold is definitely, it validates this particular bias, because we are comfortable. That is traditionally what our forefathers have invested in. And that's what we've seen. And this particular bias is, of course, seen in the older generation. It's higher. But what happens is that a portfolio is created without adequate diversification. And familiar is not equivalent to safe. So there is huge amount of concentration risk. Let's say somebody has the comfort with an insurance product, LIC, it doesn't make their portfolios robust or safe. Likewise, investing in FDs, because you have comfort in investing in FDs. So again, Sumera, asset allocation needs to be worked out, but overcoming this particular bias, familiarity bias, is not easy, and it has to be a process. So you decide that this is the correct asset allocation, and only over a period of, let's say, 3 to 5 years, you can gradually move to the right asset allocation, because these biases are, not very easy to overcome what is ingrained in your mind so strongly.
Prableen, if you look at this BEFI barometer survey, if there is one parameter on which the bias seems to have reduced, its conformity bias. Actually, 1% fewer people are succumbing to it. So how can the rest of this 24% avoid it?
Confirmation bias, again, is something that, we all love to be validated. We all, for things that we believe in, we all like to seek support. And when it comes to investing, there are investors who constantly look or cherry pick information which validates their own conviction and thought process. And they tend to take concentrated bets, I think, because from 2019 to 20, there was this shift, the pandemic, and probably that is why we saw a little reduction there, because probably the conviction of investors was hit. So it is so important because this particular confirmation bias, it leads to overconfidence. It leads to, thinking that if you're in a bear market, it's always going to be like that. If you're in a bull market, it's always going to be like that. And you tend to shift your asset allocation and, create it, make it in a way which is not healthy for the long term. So how do you overcome is always look for a contrary view. And whenever you're reading about something, looking at an investment option, I think so important to look at more than one source of information so that you get different opinions, about the same investment or the same company, the same scheme, whatever you're looking to invest in.
Got it. And finally, the sharpest rise amongst investors' behavioral biases is in something called the framing bias. Now, I must admit, I've never heard of it before. What is it exactly?
Framing bias, Sumera, you, me, I think we all are a victim of it. It's something on which advertising actually works. If I tell that I'm giving an example of an airbag. If I say that, it is 90% effective, vis-a-vis I say that it has a failure rate of 10%, the first piece of information is more appealing. It is more effective. And this is what framing bias means. Because the same information, if it is presented in a different way, investors react differently to it. And investors are induced to invest in a certain opportunity, in a different, in a certain fund or any product, when details for that investments are presented very optimistically. So it's so important for investors to understand that why are they investing? They really need to understand that question so that they don't fall a victim to this. Especially in bull markets, we see number of IPOs increases, number of NFOs increases. There's nothing wrong in investing in them. but it's important that it's the structure. You know, currently we are in a very optimistic market environment. There is positive sentiments are positive, and that is why we see more of these. Investors have to understand before investing that what matters is the suitability of that product for their own portfolio, and then only invest, and not fall a victim to a let's say a good presentation or a good sounding investment strategy or a story.
Understood. Prableen, thank you so much for joining in. I guess we all need to introspect a little bit and see which of these is affecting or clouding our judgment, and try to work on it to improve or